A question that's quite commonly asked by a lot of my clients is, Sanjay, how are insurance companies rated? Now, a little background for you. My name is Dr. Sanjay Tolani. I've been in the business for more than 17 years. I've been a top of the table member for the last 13 years, which is probably one of the highest levels of qualification that a person can get in the insurance business. And to know how insurance companies are rated, it's about understanding what's the meaning of rating. Rating is based on a certain number of factors. Number one is solvency. Number two is, do they have the right management structure? Number three, do they have a proper financial plan and a succession plan for their top management? And there are quite a few number of criteria which affects the rating of insurance companies. But just like any other company in the stock market or any other company in the world, there are agencies that rate insurance companies to know, are they good, are they bad? Majority of insurance companies have a decent rating because they don't carry the risk. They pass on the risk to another company, which is what we call reinsurance. So that allows insurance companies to manage risk to a certain extent, and then if they cross that risk limit, they then send that risk to another person or to another company. And that is what we call the risk pool. It's about understanding the entire insurance industry works like a big swimming pool, where every pool is independent, however they are connected with other pools. So it allows the entire industry to work together. It's one of the very few industries where the entire industry works together. So this is a profession that is dependent on other members as well. So it's never about just understanding one company's rating, but about understanding that the entire industry works to secure its members. So the insurance industry is a very united industry because it allows us to all work together. And that's why ratings are important, because it allows us to know which swimming pool is shallow, which swimming pool is deep, and then we can exchange the risks. The risk in one part of the world is different from the risk in another part of the world. Like, for example, you would have a lot of hurricanes and tornadoes in one part of the world. In the other part of the world, you might have a lot of earthquakes. You might have diseases. So you might have certain illnesses that are very common in certain parts of the world, which are different from other parts of the world. So they can share the risk, and the risk is allowed to be divided globally. So the whole world works together to make sure that this is protected. And that's the beauty of insurance, that the ratings are done by third parties, but the whole industry works together to protect each other.